Okay, so now we're going to talk about features of common stock and preferred stock. Okay, when we talk about stock, again, this is the equity side of our capital structure. This is ownership. So we own the company, we have a say in what goes on with the company. So we have voting rights. Um, those of you that own stock, you get something in the mail once a quarter. May have your dividend check in there. Your dividends may be deposited automatically, but generally what happens is in that it tells you, hey, this is what's going on with the company. This is what we have coming up. This is when our next board meeting is. Quite honestly, most people just throw that out, take the check, and cash it, right? But you do have a say in the company, and you can vote and mail that in and send it back. Or you can go to the stock meeting and vote in person. The other thing we can do is proxy voting. So if we are not going to go to the meeting and we can use proxy voting and let someone else vote for us if we want them to. Quite honestly, that's how you can take over a company, is you get enough people to give you their right to vote, then you could go to a board meeting and pretty much have the votes to uh, do what you want. Takes a lot of votes. There's a lot of stock out there. Okay, doesn't happen as often as it used to. Also, there's different classes of stock. If you look at Google, when Alphabet, the hedge fund, bought Google, they wanted another cash inflection. So if you look up Google stock, there is actually GOOG. That's the original stock, and then there's GOOGL, and that was the release once Alphabet took over the company. If you look at something like Ford Motor Company, Ford has Class A, B, C, and I can't remember. They may have a Class D stock. Okay, Class A and B stock are voting stocks. Um, if they don't have a Class D, then Class C is non-voting. If they have a Class C, then A, B, and C vote. D doesn't vote. Okay, but the way their classes are structured, most of the weights in the voting is in the Class A stock, and the Ford family owns all of the Class A stock. That's one way they can maintain control of Ford and have a say and or basically dictate what goes on with the company. Is Class A stock is owned by the family. That's where most of the voting rights are. Okay. Some other rights, obviously, if you own 10% of the company, then you get 10% of the dividends once they're declared by the board. Okay. If the company is liquidated for any reason, then you would also get 10% of that liquidation. Now, the other good thing about having stock is you have a preemptive right at first share of new stocks. So if you own 10% of the company and they're going to come out with new stock, then for you to maintain your 10% ownership, you would have to buy 10% of that new issue of stock. It's one reason when companies need to get capital, stock might be one of the last ways to go about doing that, because the current owners have to put more in. So if that's the case, just either ask them for the money or let's go look at it from raising capital in bonds or debt or some other way. Okay. Now, unlike bonds, dividends are not a liability of the firm until they are declared by the board. Okay, so if the board doesn't declare dividends, okay, we can't force them into bankruptcy. Now, if they're not going to declare dividends, though, we hope that they're using that money, putting it in retained earnings to fund growth in the future. So we might be willing to forego dividends for a year, maybe two, knowing that that's growing the company. The value of our stock is going up, and we're going to get higher dividends down the road. Depends on the case and on the company. Okay. Now, unlike bonds too, dividends are not declared an expense of the company. Remember, dividends are paid out of net income. Okay, so we've already taken care of the taxes, we paid interest and all that other stuff. So that is why dividends are not tax deductible. Unlike bonds, which are loans, that interest is tax deductible and comes out before we calculate taxes. If you remember back to chapter 2 when we were talking about the income statement, right? So we already paid taxes on the money on that we use for dividends. Okay, since that's paid out of net income. That's why that's one of the downsides of dividends is double taxation. The company pays taxes on it. They declare dividends. That comes out of net income. Then we, as investors or owners of the company, receive those dividends. And depending on what we're doing, we can either have those reinvested into the company or into more stock, trying to buy more stock, or we have to declare that as income. And then we'd end up paying taxes on it again. Okay. You can see here dividends received by corporations have a 70% exclusion. Quite honestly, folks, I don't know much about that. I leave that to my accountant, and that's why I have an accountant. Let them deal with that headache. Okay. Now, when we flip the coin from common stock to preferred stock, dividends must be paid to preferred stockholders before they're paid to common stockholders. Okay. And dividends, again, aren't a liability of the firm until they're declared by the board, but preferred dividends can be deferred indefinitely. So if you have a situation where the company is saying, hey, we're not going to pay dividends for 2 years because we're going to use that money to fund our growth, we're going to keep that in retained earnings. Then when they declare dividends in year 3, they must go back and pay those preferred stockholders their dividends in those first 2 years. Okay. Now, for kind of that guaranteed income, if you want to call it that, we give up the voting rights with preferred stock.